FXN Mentoring, what's up, guys? Welcome back to Trading with Market Makers, and welcome to week 3. So I hope the first 2 weeks that you've learned quite a bit. I know that we've primarily focused on the last 2 weeks, or the first 2 weeks, I should say, with market maker cycles, and the reason that we spent so much time, or 2 weeks really, with that is because this is what essentially gives you your edge in order to trade what we're going to talk about today, which is going to be the patterns and timing, right? So what we need to do is, we've already talked about the market maker cycle. We already know how we're going to get the directional bias for our trading. So now we need to understand better the actual sessions along with the patterns and timing, which is what's going to allow us to get into the actual trades. All right, so let's literally jump right into the Asian session. So the Asian session is, what is it, right? It's basically going to be, the entire Asian session is from 5 p.m. Eastern Standard Time until 3 a.m. Eastern Standard Time. The section that we care about is from 8 p.m. Eastern until 1 a.m. Eastern. Why is that? The reason that we care more about this particular range is because this is when all of the sessions are all working at one time. So at 5 p.m. Eastern Standard Time is basically when Australia and New Zealand start trading. At 8 p.m. is when you actually get the session of Japan also starting to trade along with them. So at that point now, from 8 to 1, you basically have essentially Australia, New Zealand, and also Japan all trading at the same time. So it's very common to see, when you're looking at the charts, if you're trading an AUD, NZD, or JPY pair, it's very common for you to see the Asian ranges on those specific pairs way bigger than any other pair. And this is the reason why, is because their main trading session in the morning is literally this. Okay, so that's why you'll see their sessions, especially during the AUD and NZD pairs, when they have news at about 9:30, 10 o'clock p.m. Eastern Standard Time. You should see some huge moves happening on those specific pairs, and sometimes you'll see the Asian range by the time that it's done and over with. You'll see that Asian range could be 70 to 80 pips big. So it's very common to see on those particular pairs. So this session from 8 p.m. Eastern Standard Time and 1 a.m. Eastern Standard Time is basically what creates the Asian box on our indicators. And it sets the initial high of the day and the initial low of the day. So this initial high and low is basically what's going to be used for the start of the day. Until we get into the London session, if they do type 1s, setups that go ahead and create newer highs and lows for the actual day. But the Asian box from 8 p.m. to 1 a.m. Eastern Standard Time literally sets the initial high and low of the day. Now, the ideal range for the Asian box is going to be about 50 pips or less. Now, when we talk about the Asian range specifically with regards to the NZD, AUD, and JPY pairs, there's commonly going to be ranges well above 50 pips on a regular basis with these pairs. We know the reason why is because this is the primary time that they're actually trading. Okay. Now, we do not trade the Asian session at all. There's no trade setups at all that we take inside of the Asian box. That's not what we're trading at all. Okay? But we need to identify the box so we know what the range is that we're going to be working with for the rest of the day. Okay? So that essentially is the Asian session. Let's talk about the London session now. So what is the London session? The London session is basically the entire London is from 3 a.m. to 11 a.m. Eastern Standard Time. Now, this section is what we care about, is from 3 a.m. to 7 a.m. This is the timing aspect that we want. The trade setups that we want to trade are going to happen between this time, 3 a.m. to 7 a.m. Eastern Standard Time, basically New York time. Okay? That is your trading. If you're trading London session, you should be up during this range, 3 a.m. to 7 a.m. Eastern Standard Time. This session from 3 to 7 is the London box, and it sets the high and low of the day for starters. So we have the Asian session that starts the initial high and low of the day, and then the London session actually creates it for the actual day in Forex. And it's going to happen between this time of 3 a.m. to 7 a.m. Eastern Standard Time. The London session has the most volume out of all of the sessions in Forex. The most volume is moved during London, not US. Most trade setups, if both legs of the M and W were in London, will take place before 6 a.m. Eastern Standard Time. This is where the high and the low of the day are set. Okay, so the trade setups that we're looking for, most of the time, you're going to be looking for those trade setups that happen before 6 a.m. Eastern Standard Time. Are they going to be setups that happen after that? Yes, of course. That's why we have the range of until 7 a.m. Okay? But the majority of the really good trade setups are going to happen before 6 a.m. Let's talk about the U.S. session. So the U.S. session itself, the entire U.S. session, is essentially from 8 a.m. Eastern Standard Time to 5 p.m. Eastern Standard Time. The point in time that we care about is from 8 a.m. to 12 p.m. Eastern Standard Time. That's basically the U.S. session box, right? So you're going to notice that we have 3 boxes in the indicators, right? We have the Asian box, the London box, and the U.S. session box. So the London and U.S. boxes are there to help you identify the range of where we want the trade setups to develop and appear in. So essentially, the trade setups that you're going to be taking have to be inside of that box. So again, the session from 8 to 12 is the U.S. box. The U.S. session has the second most volume out of all the sessions, and then finally followed by the Asian session being the third. Okay. Most trade setups in the U.S. session will take place before 11 a.m. Eastern Standard Time. It's just like the same thing with London, right? We have most trade setups happen before 6 a.m. Well, in the U.S. session, most trades should happen before 11 a.m. Are there going to be trades that happen after that? Absolutely, they are. Yes. That's why we have a buffer of 12 p.m. Eastern Standard Time. Okay? The only time that this ever changes, by the way, is whenever there's FOMC news, which that happens at 2 p.m. Eastern Standard Time. Okay? That's literally the only time, the only exception to this rule is when you can take trades. Is FOMC, most markets are going to consolidate to set up for FOMC news because it's a high volatility type of news release and it moves the markets. So for the majority of the time on those days, you'll see that the markets really don't have a setup until the FOMC news hits. Now, very important that if you are trading the U.S. session, right, if that's the session that you chose, that you say, hey, I'm going to trade the U.S. session because that's what I can trade right now, I think it's going to be a lot simpler for you to trade the US session, because essentially what you're doing is you're looking for continuation and reversal trade setups is what you're mainly going to be focused in on during the US session. So continuation and reversal trade setups are the two main setups that you're going to look for in the US session. Most reversal trade setups in the US session will go to the 50 and then consolidate for the rest of the day. Go look at all of your pairs, and you'll see if there's a reversal that happens, so like an M or W reversal that happens in the US session, the majority of the time they will literally go to the 50 EMA and then consolidate and go sideways for the rest of the day. So a lot of times when we talk about entries and exits and stuff like that in other videos within the program, the 50 EMA is going to be used as a take profit if you're trading the US session. Okay? So let's talk about patterns and timing. So these two things have to be together in order for the trade setup to be a valid trade setup. You got to have the pattern, and you got to have the pattern in the right timing. Both of them have to be there for this to work. If you have the pattern but it's in the wrong timing, then it's not a trade setup. Okay? Because if you have a pattern that happens during the Asian session, well, who cares? That's not during the right timing. But when you have the directional bias that we've talked about for the last 2 weeks, along with the pattern and timing, that right there is your formula for the right trade setup. So let's talk about it. So pattern and timing, the first thing is we're going to have 4 types of patterns that we want to trade, right? Type 1, type 2, type 3, type 4. Each pattern has a specific set of rules and characteristics. The timing of when each pattern happens is the major key of the pattern. The timing, I can't express that enough, guys. The timing of it matters so much. The timing of it matters so much. If you look at a chart, any chart, doesn't matter what pair you look at, you will literally see M's and W's all over the place, right? You'll literally see them all over the place. So it's very important that we understand the pattern, which is the M or the W, but the timing aspect is huge because that's what allows us to validate the actual pattern that's correct versus the one that's not correct. So let's talk about type 1 patterns. So type 1 pattern is a sharp move that pushes outside of the Asian high or low. Remember the Asian box, right? It's from 8 p.m. until 1 a.m. Eastern Standard Time. Type 1's patterns is a sharp move that pushes outside of that box, either high or low, pushes above or below. Typically, this move or the move could be up to 50 pips when measured from the top or the bottom of the Asian box. So up to 50 pips above or below the bottom of the Asian box. We're looking for an M or W formation. That's what we're looking for. We trade M or W formations. We don't trade a single formation like an A or a V. Okay? We trade M or W. I'm giving you the very simplest way, the simplest system, so you're not confused on trading at all. I can't make it any more simpler. Once you're done with the program, you'll know what I'm talking about. But I can't make it any simpler. The best setups come when the apex of the M or W have 5 candles or more. So essentially, you want the M or W between the first and the second leg of the M or W, you want there to be at least 5 candles. Those M's and W's produce the best setups. Are there going to be M's and W's that have less than 5 candles between the first and second leg? Absolutely. But they're not the ones that we're looking for. We're looking for very specific patterns within the right timing when we have the correct directional bias. This is a system and it all works together. Okay, so one of the primary things for the right pattern is 5 or more candles. The second leg of the M or W must be inside of either the London box or the New York box. There's no exception to that. So meaning that the second leg of that M or W, it doesn't matter where the first leg is, it matters where the second leg ends up. As long as it's within the box of the New York or the London session, then it'll be a good trade setup. But if the second leg of the M or W is not inside of that box, then we don't trade it. We don't trade it. Are there going to be setups that happen where the M or W, the second leg, is 5 or more candles, but the second leg doesn't appear in the box? Yes. Yes. The reason I'm giving you these specific rules is because I know that over an extended period of time, if you start taking those specific trades that are outside the parameters, you're going to end up losing more than winning. And the whole point of this is to have a consistent winning ratio over an extended period of time. We're not worried about trading only for a week or month or 6 months. We're talking about trying to do this for years. So what's the best way that we can be consistent over years? Not months, years. Right? And so what you're going to notice about these setups when you start doing homework and things of that nature is that they don't happen every day. And that is okay. These setups don't happen every day, and that's okay. When you're with the right setup, with the correct set of rules that I'm giving you, you should be able to find at least 3 to 4 really good trades every week that meet all of the requirements. Once you're done with the program, you'll know all the requirements, all of the rules of entries and exits and all that stuff. But you should be able to find 3 to 4 very good high quality trades every week. And if you're trading a standard lot size, 30 pips, 30 pips or so a trade, do the math. Each trade is about $300. 300 times 3 or 4, what is that? About $1,200 or so a week. But again, it all comes down to following the rules that I give you and not deviating from it. So here's what a type 1 setup looks like. You could see price action moves straight to the bottom, past the bottom of the Asian range, and then creates the W pattern. There's more than 5 candles between the first and the second leg, and then it goes up. That's what traditionally a type 1 pattern is. Right now, I don't want you to focus on entries, exits, anything like that. This week, I literally just want you to focus on the pattern and the timing. We'll talk about entries, we'll talk about exits in another video, I promise. So this week, just focus solely on the pattern and the timing of it. Okay? So this is what a type 1 pattern looks like. Let's talk about type 2 patterns. So type 2 pattern is a move that essentially gets stuck at the top or the bottom of the Asian range. Price action does not move outside of the initial high or the initial low that's set throughout the Asian range. Now, one caveat to this is that you're going to see that there's going to be times where price action is literally like, it seems to be like right above the initial high or the initial low of the day, or riding that line of the Asian high or low. And that's still fine as a type 2 pattern. Okay? It doesn't have to be perfect, but you'll see those variations of the pattern where price action is literally right on top of the line. It's not directly perfectly touching the top. It's literally going a little bit above, and it's literally like riding on the line itself. And that's perfectly still fine, still valid. You're looking the same thing for an M or W formation. And the same thing, the best setups come when the apex have 5 or more candles. So basically the exact same thing. 5 or more candles between the first and second leg. And the same rules apply. Second leg of the M or W must be in the London or the New York box. That's it. Okay, so what does that look like? It looks like this. You see how the first leg goes right a little bit past the line of the top of the Asian range. This is what I'm talking about when it's riding the top of the Asian range. Look at the spikes on this example. Right? Look at the spikes on this example. Comes down, it's got more than 5 candles between the first and second leg. And then it comes straight down. This is traditionally what you want to see in a type 2 setup. So let's talk about type 3 setups. So type 3 setups are defined as a move that comes from the top or the bottom of the Asian range and hits a brick wall when it gets to the middle of the Asian range. So think about it. It's coming from the bottom or the top, and then all of a sudden, it just hits a brick wall when it gets to the middle. On these kind of setups, you're very likely to pin a 50 EMA when it hits the middle of the Asian range. Another thing that you might see is that you'll notice that the 50 EMA acts as a form of resistance and sometimes prevents price action from getting accurately to the middle of the range. So the 50 EMA blocks essentially price action from getting up to the middle of the range. And you'll see that when you go through the examples from the homework and stuff. Now you're looking for a railroad track, a star pattern, or a cord of wood in the middle of the range. So the difference between the type 3 setup is that most of the time you're not going to get an M or a W. What you'll end up getting is a one-legged pattern, which is basically railroad track, star pattern, or a cord of wood in the middle of the range. So this pattern, it will produce M's or W's, but the majority of the time, like I just said, will only give you one leg, which is one of these patterns, a railroad track, star pattern, or a cord of wood. The majority of the time, this pattern happens in the London session. All right? So the majority of the time, this pattern will happen in the London session. So what does it look like? Here you go. So here we have price action coming out from the bottom of the range, and you can see that you have you come out from the bottom of the range, you get a railroad track, and then you go up, and then all of a sudden you hit the brakes there in the middle, and you end up getting a star pattern. Now, one thing I want you guys to notice is, do you see how that star pattern has two dojis in the middle, right, instead of one? That pattern itself, whenever you see either 2 or 3 dojis in the middle, we like to call that God mode. One of our students named that. And so they like to call it God mode because it's almost a guarantee reversal. Okay? But you'll see a lot of that. But this specific mode is just it's a star pattern, right? It's a big fat blue candle followed by 2 dojis and then a big fat red candle. Most of the time you're only going to get that one doji in the middle, but the more dojis in the middle, the more confirmation that it gives us. So let's talk type 4 patterns. So type 4 patterns is an aggressive move that comes out of the Asian range and breaks through the top or the bottom of the Asian range. Right? It's a sharp aggressive move that breaks through the top or the bottom of the Asian range. This aggressive move looks like the beginning of a type 1 pattern. After the aggressive move you're looking for essentially a retracement back to either the top or the bottom of the Asian range. So essentially you have a big move that breaks through the top or the bottom of the Asian range, and then essentially you have a retracement. That retracement literally goes back to either the top or the bottom of the Asian range. And then it goes up again. Think of it like a type 3 pattern, but instead of it happening in the middle of the range, it's happening at the top or the bottom of the range. So this pattern, again, the same thing. The majority of the time only gives you one leg. It's a railroad track or star pattern most of the time that you'll get either at the bottom or the top of the Asian range. And the same thing, the majority of the time this pattern happens in the London session, just like the type 3 setup. It's almost like this could be like a type 3 setup, but if you just move it up or lower to the top or the bottom of the range. So here's what it looks like. You have an aggressive move straight out from the Asian session, and then you see the retracement. The retracement literally goes, in this case, to the top of the range, and then boom, it just goes. It's almost like, if you recall, if you've read a lot of the Forex books out there about a break and retest type of strategy, where the price action breaks the resistance, comes back to retest it, and then goes. Same type of ideology, except for this is breaking, retesting the Asian high or low. Same concept. Now I want you to keep in mind that these patterns don't happen very often. Okay? So type 4 patterns aren't very common. They do happen, that's why I'm showing you what it looks like so you can be aware of it, but they rarely happen. Okay, they're not very common. All right? So now let's talk about the variations of the patterns, because there's a lot of them. Okay, so I'm going to show you essentially what different variations of patterns you will find out there. And this should help you a lot when we talk about your homework and stuff. So here are the variations of the different patterns, right? So here is a type 1 pattern, okay? Now, the key point here is that this is a multi-session type 1 pattern, meaning that when a multi-session type 1 pattern happens, the first leg is essentially in London, and the second leg is in the US session. Now, you might be asking yourself, like, Mark, this looks like a type 3 pattern, right? Because it has the first leg comes down, bounces off the middle, and then it goes up. Yes, it looks like a type 3 pattern, but what you're missing is a directional bias. This specific pattern is coming off of a peak formation high. So you wouldn't be looking for bias to begin with. You'd be looking for sells. So this is a really good example of why that directional bias is important. Because if you don't have that directional bias, guess what? You would be buying this type 3, right? You'd think that this is a type 3 and you'd be buying it. When essentially you have to be patient, and this will produce a multi-session type 1. Okay. This next one here is a type 2 pattern, right? First leg right at the beginning of the session comes up. You got way more than 5 candles between the first and the second leg, and then boom. You see how it touches the bottom of the Asian range? That's a type 2. This right here is what we call a trade out of the edge. And what does that mean exactly? A trade out of the edge is essentially when you have the first leg of the W or M inside of the Asian session. And the second leg happens right at the beginning of the London session. Now, a couple of caveats that I found with this specific trade setup that you're looking at. For this trade setup to be effective, the second leg that happens at the very beginning of the London session, majority of the time has to happen before 4:30. Okay. Again, these are not very common. These are not as common patterns, but I need you to look so you can see what they look like. So this right here, you see how the second leg is riding the bottom of the Asian range. This would still be considered a type 2 pattern. This would not be considered a type 1 pattern. A type 1 pattern needs to break away from the bottom of that range. Okay? This is still literally riding the bottom of that range, right? But I want you guys to look at this and see the first leg in the Asian box, and the second leg essentially is right at the beginning of the London session. Okay, not these particular setups are not as common, but you know what they look like now. Here is a type 1 pattern, and this is where both legs essentially are inside of the London box. Again, when you look at this setup, you're probably thinking to yourself, well, why wouldn't I take that as a type 3 setup when you have price action coming back down to the middle and getting rejected? Again, you wouldn't be looking for that kind of setup because you have your directional bias, and this is also coming off of a peak formation high. So you're really looking for sells. And so this is why it's so important that we took 2 weeks to get to know the market maker cycle, because we need that directional bias to find the actual trade setups that we want to trade. So this, again, would be a type 1 setup. You have more than 5 candles between the first and second leg. You could see essentially that the second leg ends up being a star pattern. And then you get a pullback on the very next candle that you can use for entry. Here is an example of a type 3 pattern, right? Price action comes from the bottom and then gets stuck in the middle of the range and then boom, drops. Now notice, here's what I want you to notice about this one is the fact that you see how the second leg doesn't reach, or even the first leg doesn't reach the middle of the range. What you're missing from this that you can't see is that the 50 EMA is actually right there blocking price action from going directly to the middle of the range. And so if you see this where the 50 is blocking price action from getting to the middle of the range, this is still a type 3. Okay? And same thing. You get a railroad track second leg with a pullback. All right? Focus in on this week, just focus in on the patterns and timing. I don't care about entries. We're not talking about that right now. All right? It's just important for you to know what is the right pattern versus what is the wrong pattern, the trade. Here's another type 3 pattern. You could see essentially coming from the bottom, we get a star pattern here right at the middle, and then it drops. Here's another example of a trade out of the edge, type 2, where you have the first leg in the Asian session and then the second leg right at the beginning of the London session. Okay. Same thing, way more than 5 candles between the first and second leg. In this case, on the second leg, you get railroad tracks to help you confirm entry. This is a type 3 pattern here. You could see essentially price comes up from the bottom, goes to the top, comes back to the middle, gives you a rejection and a railroad track right there, and then boom, you're off to the races. Again, all of these trade setups that I picked are going with the directional bias. So all these setups that you're seeing that I'm showing you are literally in the correct directional bias. So in this case, this one here is coming off of peak formation low, right? So you're looking for buys, right? That's really important for you to understand. Are there going to be setups that go against your directional bias that are tradable? Yes. There's going to be setups that you can trade against the directional bias that are going to be good setups. I don't want you to worry about that right now. You'll be able to do that later when you get comfortable in advance in trading. For right now, we're trying to keep it as simple as possible. And I can't get any more simpler than possible than giving you the rules that I'm giving you throughout this program so you can just start going right ahead and you have a system in place that you can just follow. But here's a type 3 with a railroad track as the entry. This one here is another type 3. You can see coming out. Here's an important factor. Look at this example here. Do you see how it's coming out of the middle of the range like that? If you ever see price action coming from the middle of the range, coming out of the middle of the range after Asia like this, it needs to go to the top or to the bottom before you could trade it. Okay? So when you're looking for examples here, and you see this behavior of coming out of the middle of the range like this, remember, price has to go to the top. Like in this example, it goes right to the top and then comes down to the middle of the range, gets rejected, gets you a railroad track. Okay? If it's just coming out of the middle and then it goes without going to the top and then retracing or going to the bottom and retracing, that's not the setup that we want. Okay? We don't trade any setups that just come out of the middle and just go. We want the setups to come from the top or the bottom. Okay? Here's another one. Coming from the bottom, goes to the top, goes back down, rejects, give you a railroad track, and goes. Again, for those of you thinking that this would be maybe a type 2 pattern in London, it wouldn't be, because you'd be looking for buys based off of the directional bias off of the market maker cycle. Here's another one. You can see on this one here that price action doesn't make it to the middle of the range. What you're not seeing is that the 50 EMA is holding it from getting there. Okay. Here's another important distinction is the fact that you see when you go to the top here from the Asian range to the top of the London session, you see how you have that big doji there, right? Big candle, two small dojis, and then a big fat red candle. Again, this is coming off the premise that you're coming off a peak formation low, so you're looking for buys. So this pattern here wouldn't seduce you to go into a sell. Okay? So this is why we go through that. This is what's going to keep you from taking those trades, is the directional bias. So that's a type 3. Here is a multi-session type 2 pattern where you have a type 2 pattern actually during London, right? Your directional bias is coming off a peak formation high, so you're looking for sells. So here's an example, okay, of what could happen if you take an M, an M basically in London that meets all the rules, right? It's got 5 candles between the first and second leg. It gets stopped in the middle of the range, goes back up, and then actually does the drop that you wanted to. You have to think about what's happening here that's causing this to happen, okay? If you have a pattern like this of the type 2 in London and you take the trade, okay, and let's say you get stopped out by this retracement that happens, I want you to pay attention to what's happening at the beginning of the US session. You see those 2 pin bars there at the beginning of the US session. You see those? That is market maker behavior grabbing orders and liquidity up there. So the reason that this is actually happening is it's happening because they made the pattern of a type 2 pattern in London, but when they got to the middle of the range, they're like, shit, we don't have enough traders buying so we can go down and make the move that we want to make for the rest of the day. We have to get more traders to buy so we can take the opposite side of the sell. So what do? They go right back up and retest those highs again. See how they don't like to go past a certain point. Because if they do, they can release essentially the traders into break-even trades. Okay? So notice the behavior here. You may take this trade in London and you may lose, right? You may get taken out or whatever because of the retracement. But pay attention to the fact that the retracement was just more of a grab on liquidity that's above you, because they needed that liquidity to make the strong move all the way down again. Okay? This one here is an example of a type 4. See the aggressive move that happened super early in Asia and then came right back down to the top of the range. You had a huge bull candle. You see that? Huge bull candle out of the top of the range, but then came back as a retracement. That retracement is where you would get in at. But I just want you to see the pattern. The pattern and the timing. Okay? This is what a type 4 looks like. Here's another type 4. You could see early move in the Asian range. Early move in the Asian range, but then comes back and tags the top of the Asian range. Now, if you're looking at this, some of you might be thinking, well, why isn't that a type 1 in London? Right? Well, for one, you're coming off a peak formation low, so you'd be looking for buys, not sells. Number two is that you don't have 5 candles between the first and second leg if you were looking for sells anyways. Okay? But you could see you have a huge aggressive move that starts early in the Asian session, but then comes down and tags the top. Basically breaks the Asian high, comes back to retest, and then you get a railroad track actually to go. Here's another type 1 pattern where essentially you actually have 2 trades here. You have a type 1 in the London session where you see the first leg gives you railroad track, comes back to the second leg. Second leg gives you a star pattern, right? You have 5 candles between the first and second leg. You get a pullback for the entry, but just realize on the pattern, the second leg is inside of the London box. The first leg is not, right? The first leg is out in the middle open space, but the second leg, again, is inside of the London box, so that's a valid trade. Now take a look at what happens in the US session. US session, basically you get a reversal. You get the first leg in London, second leg is at the beginning of the US session on a railroad track. So you essentially get 2 trades in one day on this specific day on this pair. So during the US session, you basically get a reversal. So you get a type 1 in London and then a reversal during the US session. Here's another trade setup. This one's a multi-session type 2 setup where the first leg is in London, second leg is at the beginning of the US session. And the same thing, you could see price action is coming from the top to the middle of the range and gets rejected over and over and over again. Why aren't you taking that as a type 3? Well, you're not taking that as a type 3 because your directional bias is to sell because you're coming off a peak formation high. So you're not looking for buys, you're looking for sells. And so I'm showing you this because I want you to understand the patience that sometimes you're going to need in order to wait for the right trade setup. The patience that you're going to need in order to wait for the right trade setup. So this one, here's a type 3 pattern. We're coming from the bottom to the middle. We get rejected, we get a railroad track, and then boom, straight down. And this one ends up being kind of the same thing where you get multiple setups in the same day. So you get a type 3 during London, and look what happens. You get a multi-session W in the US session. This specific setup here in the US session, I can tell you, was based off of news, because look at that big old candle wick back and forth on that candle. That's 8:30 news, and it's on a Friday, so this is probably NFP right there, is what that is. But nevertheless, you still get a setup there. Here we have a type 3 setup where we're coming out of the middle of the range. You see we come down to the bottom we move sideways, and then we finally come back and retest the middle of the range and get basically a railroad track. And then we drop off the rest of the day. Again, the main thing that you're getting out of this is you're coming off a peak formation high. You get price action coming out of the middle of the range. You're waiting until it gets either to the top or the bottom. In this case, it goes to the bottom, moves back and forth, back and forth. You get one swing to the middle, get rejected on a railroad track, and then boom, you drop. So that's your pattern there. Okay? So we've went through a bunch of different examples so you know what these patterns look like. Let's talk about homework. So what I want you to do for homework this week is I want you to take 5 pairs of your choice. I don't care what pairs you want. Pick 5 pairs, and I want you to find the patterns. Type 1s, 2s, 3s, and 4s. Okay? All patterns must be within the correct timing, London or the US session boxes only. Right? Meaning that we only care about the pattern being in the right timing. So only send me the patterns that matter, right? Type 1, 2, 3, 4, whatever. It doesn't matter as long as it's got to be in the right timing. It's got to be only in the London or the US boxes. It could be, trade out of the edge. It could be a type 4, whatever. It doesn't matter. As long as it's within the right timing. I want you to label and draw out each pattern. Okay? And what I need you to mark up 20 examples of type 1s, 2s, and 3s. So that's 20 type 1s, 20 type 2s, 20 type 3s. Yes, 20 of each. And then mark up 10 examples of type 4 patterns. I'm only doing 10 of type 4s because I know that they're not very common. Okay? Very important, okay, for this homework, that you use the replay feature when you're marking out and you're saving the files. Okay, so essentially, here's what I want you to look for. Here's what I wanted to look at. Here's what I want the examples to look like this. So here's an example of a multi-session type 1 pattern, right? I drew out the pattern and labeled it. That's what I want it to look like. Okay, so that's your homework example there of what I want it to look like. So how do you get there? Let me show you just so we're crystal clear on what I want you guys to do with this. So let's say that I'm doing this example here, right? You notice how the boxes are not like, completely full. If you go up here to replay, start at replay at the end of the day, and then it'll draw out the boxes for you to where it looks like this. Okay? And then you can use this tool here to go ahead and draw out the patterns like this, right? And then you can use the T here for text, and then you could type in, London session type 1. Click OK, and there you go. And so same thing, right? You go to the camera, you click on copy link to chart image, same thing as before. You'll get the little icon there that tells you, hey, it's been clipped to the clipboard. You don't need to search for the clipboard, just paste it, just right click and paste onto the email, and that'll produce the link. Okay? So if you're going back into the charts, essentially, for a different pattern, let's just say we're going back into the charts or whatever, and you find a pattern that meets your type 1s, 2s, or 3s. So let's say this one here, you're clicking on the replay, you're doing this so you can get the actual boxes to show up correctly, like that. Okay? Kind of open it up here, do your thing right there, put in your text. This could be a London session. Type 2 pattern. So like that. Go ahead and click the camera, click the link, and then paste it onto the email. That's it. Okay? So that's what I want for the homework this week. I don't want you to worry about entries, exits, any of that stuff. I'm only concerned with you showing me the pattern that you're seeing on the screen. This will allow me to give you the most effective feedback. Okay? I'm only concerned with what pattern are you actually seeing on the charts. Okay? But that's what I want for homework. All right, guys? So hopefully you learned a lot from this video, and we can get to learning about patterns and timing throughout the homework this week. Thank you guys so much, and have a great rest of your week.